Welcome everybody, welcome to my channel, The Financial Trader's Mindset. In this video, I'm just going to talk about the importance of having a long time horizon in your investment portfolios. Slow and steady wins the race. Having a plan, executing on that plan, and sticking with that plan. Also mitigating risk in your portfolio and finding ways to earn the base hits over and over again. When it comes to investing, a lot of people tend to reach out and shoot for the moon, go for that home run, play meme coins, shit coins, what have you. Basically just gambling, trying to make it all in one trade. And I think that just comes with the overall social media environment of showcasing large gains, taking huge risks, seeing people making 100,000, 10,000 on returns on their portfolio. It conditions people to think that's normal. And that's totally wrong, because what they don't see is the graveyard of investors that have tried and failed with these high risk investments. Crypto is very hard to hold, especially long term, through multiple cycles, the ups and downs, the losses, big pullbacks, the fast drops, the stomach wrenching roller coaster type drops that kill people's ambitions to hold for the long term. I love concentrated liquidity because it allows you to hold your assets, but earn some yield to keep the beak wet. At least I'm earning something, and it compounds over time. It's that instant gratification you've got to control. Too many people are conditioned to have that instant gratification, the short attention spans, right? But I'm here to tell you that keeping it simple, investing in quality assets, and using tools in a way that allows you to mitigate risk over time, reduce your cost basis consistently. You can see here, this is from 2021. I have earned $300,000 in yield. This is Metrix Finance. This is their tracking tool. It tracks all your liquidity pool performance on this platform. It shows my profit and loss, how much I perform versus HODL, how much yield I've earned, how much liquidity I have. It shows all that. And you can even filter it by pairs. But what I really want to highlight here is that most of my liquidity pools are in blue chips, either Bitcoin, Ethereum, or Solana, and any mix of those two with stable coins or crypto to crypto. And I want to show that having a long-term mindset, long time horizon, and being able to just stick with your plan and having the vision to see beyond that 10% drop, controlling those emotions. When Ethereum made a new high, everybody was bullish. Everybody thought we were going to break new highs, and this was the move to 5K. Then we drew down big. A lot of people capitulated here. That's why prices were low. Nobody wanted to own it. But having that long-term mindset, stay invested, having that long-term vision and conviction in your investments is key. For me, I just saw it getting cheaper and cheaper, so I was buying more as the price went down. When you go through a drawdown and you're at the breaking point of stopping out, but the asset hasn't, you planned for holding it and buying more at lower prices, here's a tip. When you feel like you're just about to go to the computer and sell everything, give yourself 1 or 2 days, 24 to 48 hours. If within those 2 days, you still want to sell the asset, then go ahead and do it. But 9 times out of 10, you're going to come back and be glad you didn't do it. And that's how you stick to your investments. Of course, you have invalidation levels. You stop out, say something fundamentally changes with the investment that changes your view. Obviously, you might have to stop out and reassess. But what I'm talking about is pure emotion, that gut-wrenching feeling when the prices are dropping. And the only reason you want to sell is because you hate to see the price dropping. Give yourself 1 or 2 days, and I'm sure it would help you a tremendous amount. Because how many times have we stopped out of a position only to see it maybe months later do exactly what you wanted it to do? And then you're looking back at the price action, people capitulating at the wrong time, getting bearish at the bottom. That's what I did with Ethereum here. I've earned almost $300,000 in yield across my wallets using concentrated liquidity. My strategy is primarily accumulating assets as price draws down and then distributing them on the way up. Sometimes I accumulate and then I leverage up by taking the spot asset and putting it on Aave. If you think logically about concentrating liquidity from 4K down to 1,300, so why would I sell it at the same prices? They're accumulating the assets, but then they have the same ranges on the way up. If you think about it, it's what kind of business are you running? If you think of this as a business, I want to accumulate the assets as cheap as I can right? Buying low, and then I want to mark them up at higher prices in the future. How profitable is a business if I'm just buying on the way down and then selling at the exact same prices on the way up? Doesn't make sense, right? Why not maximize those gains? Why not maximize the opportunity? Why not maximize the fact that you're taking all this risk? Think of it that way. That's how you can really maximize your gains in this space. The value of my assets when I hold them in spot or when they're staked on Aave, the value of those going up over time. So you can only imagine the gains I have with Ethereum near all-time highs. I just sold my first bit of Ethereum since buying down here at 1,400. I started leveraging up around $2,000 per Ethereum. And then I held it in spot. I held it in Aave, leveraged against it. And I finally sold some around 4,300. It's been an amazing return. Too many people focus on just squeezing out the yield, going super tight on their ranges, trying to get that extra 20% in yield. And then they get upset when price goes out of the range, whether it's the upside or the downside. You agreed by smart contract that you wanted to sell the asset and be completely out of it at this price. And then you wanted to buy more of it and be completely bought in at this price, which is the minimum and the maximum price of your range. But no, a lot of people don't like to take responsibility. They just look at the tool. They're like, oh, this thing doesn't work. It's crap. Impermanent loss. Divergence loss. Of attacks, right? But it's, dude, honestly, if you didn't want to be buying the asset or selling the asset at those prices, then why did you set up the range? You had no business being in that liquidity pool. No business being in those ranges. So you have to figure out where you want to buy and sell the asset. And that determines what range you should set. That's why you come to Metrix Finance. And you can fine tune your ranges using their tools to forecast and see what the yields are. You could compromise on how wide of a range you go, and you pinpoint and lock it down. And you know exactly what to expect. And then you just execute. So if you look at this one, this is my very first liquidity pool. It was Shiba Inu with Ethereum. If you go down here, you could see exactly when I staked, October 20th, 2021. That was during its final euphoric run last cycle. I staked it for about 8 days. And look how much yield I earned. I staked almost $150,000 worth of liquidity. In 8 days, I made almost $23,000 in yield. Not only that, asset appreciation as well. Asset gained 51,000 in 8 days. This is what got me into concentrated liquidity. This is what made me see the possibilities. I'm like, okay, I got to figure this thing out. This is freaking amazing. Even versus HODL, it outperformed by $7,000. Of course, this is a one-off thing, not something to expect repeatedly, but I really want to showcase what is possible here. Then if you look at some of my other positions from May 2023 until March 2024, on a stake of $2,400, I earned $5,300 in yield and $2,400 in asset appreciation. Amazing, right? I only staked $2,400. You have to take that into account, and that's how you manage your risk. Staying small, the higher you are on the risk curve. If it's a blue chip, very established like Bitcoin, Ethereum, or Solana, you can go a little larger. Of course, the yields are going to be smaller, but there's no way I'm going to stake 6 figures on a meme coin. But it turned out well. Here we have another Brett ETH pool. I came up on this one, wiped out the previous losses, and came into profit. Turned out well. Ended up being a profitable trade overall. Here we got Ethereum USDC, staked to 46 grand, pulled out 52, right? And you can see this, it goes on and on. Here's a loss on an altcoin, but it's small, right? That's the idea. You can control risk. The only things you can control are how much you invest and what you invest in. If you keep it very simple, if you want to manage your risk, the higher the risk, the smaller the position. Keep it very simple. Control your risk, control your position sizing, making sure you're properly allocated in the market. And over time, you'll win. Here's Uniswap with Ethereum. I staked this on April 29th of this year, 2025. Look at the return. Amazing. These are the things that are possible in this market. You look for opportunities. Prices are dumping. You know what? There's an asset that you like that's on sale. The Black Friday sale, you accumulate, use concentrated liquidity, because the yield is like a consolation prize. Yeah, price is dumping right now, but you know what? For you to keep your liquidity there and accumulate while everyone's freaking out, we're going to pay you in yield. And you can see right here, since 2021, 4 years, a little bit more than 4 years, 300 grand, constantly churning and earning and compounding those gains. You don't have to play meme coins. You don't have to sit there and gamble. You could earn almost 2,000%, but that's because you're prepared. You're sitting and waiting on those opportunities. I just want to get the message out there that you aren't exempt from making these types of gains. You could look at it percentage wise, right? Say if you had a 10th of the position that I had. In 4 years, you make 29 grand. Hopefully seeing this, you could look inward. You could use that one indicator, better than any chart indicator out there. You go to the mirror and you look at yourself in the mirror and you determine, okay, I need a freaking change, man. I need to stop messing with these meme coins. I need to stop messing with shit coins. I need to stop gambling in the markets. I need to come up with a plan. Most people don't have a plan. They come to the markets, they're thinking it's like Vegas. That's the way people think about investing. It's crazy, but it's such a powerful tool to build wealth. I show all my trades. I show everything I do just to inspire others to change their mind and believe that they too can do it. You got to think there's also a return on your time and energy. Say you had 1/10 of this portfolio and you were in here day in, day out, trading, managing liquidity pools, trying to squeeze out a little bit of an XPR on 1/10 of the position, right? Earning 30 grand in a year to spend every day. That's still poverty level income because all that time and energy is being spent managing liquidity pools instead of building a business, improving yourself, moving up in your career. You can leverage the markets to give you those returns without having to put in so much energy and time. You save all that. You can use it for however you want. There's not a lot of YouTubers that show their P&L like this, showcase everything they do, every step in the way. I've been in concentrated liquidity for years, and it's an amazing tool. I love it to really make it in the markets. You can join my Discord. It's free to join. You can ask questions on concentrated liquidity. Whatever questions you have, I'll be happy to answer. I also have a VIP tier where I talk more about the markets, what I'm doing, what I suggest, how I would stake liquidity pools in certain situations, real time. I post my positions, I post what I'm doing, right? How I'm positioning in the market. People find that valuable. So $10. Thanks for watching. Think about it. Most people do not make it. You only see what people showcase, and they're only showcasing their highlights. For every one person, there's 100 failed people, maybe 1,000 failed investors. That's it. Good talk. See ya.